No, there's a formula that's been around for quite a while. I first saw it in the late 90s, and some of the people who see this video may remember this. There was a debate at the end of the 90s led by Bob Arnott and Peter Bernstein, and they were saying basically the next decade was going to be really lousy for markets because the previous decade was so good. And they used this formula to sort of come to that determination. And it's a pretty basic formula, but it basically says the return in the future will be the dividend yield, pretty obvious, plus whatever price changes we see. And those price changes can be broken down into earnings growth.
Right.
Investors should get paid for the success of the company, combined with what we call PE expansion or contraction. And that second figure is the one that is sort of unknowable and is driven mostly by investor behavior. So this last year, 2013, where in the heck did that 30% return come from? Obviously, investors are thinking things are really good. I don't share that view, but I stand on the sidelines and I go, wow. So the PE contraction last year was 22%. So PEs went from roughly 16 to 20.
Right.
And that was the primary driver for what we saw as returns in 2013. If you look in that matrix for what is sort of been the on-average earnings growth in PE, the average earnings growth has been around 6% per year, and the PE has been around 15. So if that were to occur in 2014, we should expect to see a 16% loss in the market. So the headline, I think, on the article they said is Surz forecast 16% loss for 2014. That's sort of my forecast, but it's realized that it's based on this things that nobody can know.
Right.
But I like the formula in that it gives you a framework for sort of formulating what your own forecast is. So in the article, I encourage the reader to develop their own forecast, and they can go to the matrix. And if they think PEs are going to be 40 and earnings growth is going to be 15, they can look in the matrix and see that that will lead to really high returns. And I certainly hope they're right. But what this does again is just gives you some wherewithal to hang your hat on what you're thinking the future returns are going to be. And this is a time of year, I think, when everybody's sort of thinking about that, and the pundits are out there; their forecasts are, as usual, all over the map.
Yeah.
So this is just another handy tool for people who think about such things.
So how does the taper play into this? Obviously.
Yeah. I could offer my own. I'll tell you my own opinion. But before
Sure.
I do, I saw an interview with Warren Buffett on YouTube about 3 weeks ago, and they asked him that question: What do you think this quantitative easing will do, tapering?
Yeah.
And I loved his answer. He said, "This is an experiment that has never been run ever, nowhere in the world ever. No one knows how it's going to turn out." And
So it's part of that unknowable.
yeah, so my crystal ball is saying we're going to get serious inflation here. And how quantitative easing and everything else is going to fit into that, I don't know. But realize that now things are being manipulated. And when that manipulation stops, something's going to give. Now, some people think it's going to be serious deflation.
Right.
I don't see that view. I really don't. The Surz prediction is serious inflation. But
okay. In terms of sectors, that's something that you're currently working on right now in terms of, what looks good for next year or what would be the beneficiaries inside of the formula.
More recently, it's been consumer staples. And I can't remember exactly what styles within staples, but and I think in terms of if my inflation forecast is right, that's probably a sector that people have to eat.
Right.
So that ought to do okay on a relative basis.
Right.
So that's the one I would pick out. Healthcare is certainly in the equation with the Affordable Care Act now.
Right.
And that's all in play. Like who's going to win, who's going to lose in the healthcare sector. So a couple of sectors that people might want to consider. And target date funds are a big deal. And one of the other things I do is target date funds.
Right.
And her question was, why are the results for target date funds all over the map in 2013? And I think your clients who are in the defined contribution space are going to be seeing that. And 2013 was a year where if you weren't heavy in U.S. stocks, you had pretty bad relative performance. So target date funds should be pretty well diversified. Anything other than U.S. stocks in your portfolio subtracted value. So U.S. stocks are up about 30, foreign stocks up about 20, and then from there on, real estate and everything else was much, much less, and commodities lost 15%. So the bottom line is target date funds that were good diversifiers, they're going to look really lousy for 2013.
Mm-hmm.
You really need to think twice before you move away from that basis, because diversification is a good thing. So
Well,
this is a side comment on what this market has done to a diversified portfolio.
right. Well, thanks so much for taking the time, and I
Thank you.
look forward to talking to you on a regular basis.
Sounds good.